Hello, and welcome to the new lecture for ICT series. And I have named this Interbank Price Delivery Algorithm, IPDA. Why? Because this is the name that ICT gave to the algorithm that runs the market. Let's go deep dive into it. So, Interbank Price Delivery Algorithm, named name and the theory is by Michael J. Harrelson. He is the Inner Circle trader, and he named it IPDA. Interbank between the banks, the price is delivered by the algorithm. It is responsible for pricing all the markets efficiently. Okay, and we have discussed on it already. It works on time and price. It changes the price based on different times of the day, of the month, of the week, of the day, of the session, of the year, all of that. Now, the thing with algorithm is that we established before in the previous lecture that algorithm, when it runs, it is repeated. It gives us signatures that we can find in the market. Okay, and those signatures are called PD arrays, which is premium discount arrays. We call them algorithmic signatures that we see in the price delivery. And again, PD arrays are premium discount arrays, which are also named by ICT. Okay, ICT gave us this language so he can give us an understanding of how the charts deliver, and we can easily talk and deliver this understanding to others. Okay, so by discussing PD arrays, we can easily tell other people what we are trying to look on the charts. So these are the PD arrays. PD means premium and discount. The first thing you will notice by looking at them is that they are almost similar. Why? Because the price, when it goes up or goes down, it moves similarly, right? The only difference is that when it goes down, it's already in a premium and it goes into a discount. And when it's down, it's already in a discount and it goes into a premium. So we established that when we are making higher prices, and when we return from that in a downtrend, we make premium arrays. Okay, and if we are in lower prices and we make a shift in market and go to upside, we make discount arrays. That's why premium arrays start from high and discount arrays start from low. Let's look at the premium arrays first. We make a high, we make a resistance block. All of this is made in succession. Okay, when the reversal starts, we talked about smart money reversals and all the different kind of reversals that market goes to some point and then it reverses from that point, right? Whenever there is a reversal from a higher point, we make premium arrays in this succession. They are all created next to each other. And same in discount array, that when we see the chart go at a place and we anticipate that it will go up now from there, we make all these arrays next to each other in succession, or one after another, or maybe some are created right next to each other, something like that. I'll give examples. So whenever there is a reversal, like we were going high, now we are going down, the first thing that happens is we create a high. As you can see on this example, chart example, we create a high. And then what is a resistance block? Resistance block, as the name suggests, it resists the price from going up. So the area from the upside of the body to the end of the wick is called the resistance block. The price should not go above this. This is why it's called a resistance block. Okay, this is the first PD array that ICT mentions after high. If you have high conviction in your point of interest where you think the reversal will happen, people actually take entries on resistance blocks for the price to go down. The next thing we have is bearish order block. When a high is created, The resistance blocks are already cleared. Then we make a small low. Price can go up again, stopped by resistance block, but then we are dumped. So when big down close candles are created, the first candle, the first up close candle before that, or consecutive up close candles are called an order block. Okay. If we are going down, the up close candles are order block, and what algorithm do is it all fires. What algorithm do here is it fires short orders for smart money. Okay, so the first up close candle, bullish candle, or consecutive candles before the down close candles that cause the change in state of delivery makes the order block. We discussed what is change in state of delivery is when we are making high lows, higher high, lower high. We make a high, we make a low, we make a lower high or higher high, and then once again we make a low that is lower than the previous low. Like let's suppose here we made a low that is lower than this low. That is a change in state of delivery. So that change before that change in state of delivery, the up close candles or consecutive up close candles is called an order block. Okay. We touched on CB multiple times in previous lectures because we needed this for examples, different things that I had needed to explain. So CB is just a sell side imbalance and buy side inefficiency. We discussed that there is a lot of sell side orders, but there is buy side inefficiency, so there are less buy side orders. This is a fair value gap. We call it a bearish fair value gap, and we can also call it an imbalance. It's a 3 candle pattern where the gap between the low of the first candle and the high of the third candle. The low of the first candle, the high of the third candle makes a CB. So we made a high, we made a resistance block, we made an order block, we made a CB. The next thing that is made is a bearish breaker. What is a bearish breaker? A bearish breaker is a price pattern in which we see there is a high made, then we make a low, then we make a higher high, then we make a lower low. The candle that makes this low is our bearish breaker. I also added the chart example over here. We made a high, we made a low, we made a higher high, we made a lower low, which makes this candle as a bearish breaker. A bearish breaker is a price pattern where the price moves in the following way: high, low, higher high, lower low. The price always refers to a breaker to make a balanced price range. We'll talk about this later, to then displace further. The thing with this area is that we made a high, low, and in this area we have a balanced price range. Why? Because we moved up, we moved down, we move up, we move down. We have delivered both sides equally. So now the price should not go up there. The wicks can go there, but the bodies of the candles will resist going up there. As you can see over here, we barely stopped before it and then went down. So that what it means, that the price always refers to the breaker. It came back to the breaker here, but it should not go above it. We can use it as an entry pattern for our trading. Okay, a very similar topic is a bearish mitigation block. It's pretty similar to a bearish breaker, but the only difference is that in a breaker we made a higher high, but in a mitigation block we make a lower high. So how it goes is high, low, lower high, lower low. A bearish mitigation block is a price pattern where the price moves in the following way: high, low, lower high, lower low. The price always refers to it, as you can see over here. We will not close above it to make a balanced price range to then displace further, which we did over here. A breaker mitigation block are similar when first looking at it, but there is a difference of higher high and a lower high. So here we made a high, we made a low, we made a lower high, we make a lower low, and then we displace lower. As you can see, pretty similar here, but we made a higher high, and here we made a lower high, as you can see over here. Okay, now we go next. What is a CISD? I thought I should add more examples for CISD in this lecture as well. So when you see the chart going upwards, we make a low, a high, a higher low, a higher high, higher low, higher high, higher low, higher high. This is called an uptrend. But as soon as when we make a higher high, then the next low is lower than the other low, we see a change in state of delivery. We have to see a lot of fair value gaps get created over here with speed. Okay. And when that happens, the next high should not go above this high. This will constitute a change in state of delivery. What does that mean? Change in state of delivery. Delivery of what? Price. The price was delivering higher, now it's delivering lower, right? So there was a change in state of delivery from bearish to bullish, or from bullish to bearish. In this scenario, it was bullish and the delivery state changed into bearish. We take a chart example over here. I noted there is a low over here, then we create a high, we go down, we make a higher low, we make a higher high, we make a higher low, we make a higher high, we make a higher low. At this point, we make a lower high, and then we make a lower low, which makes this a change in state of delivery. A lower low, a lower low. See the price now, price is going down now after the change in state of delivery. Now we look at the complete example. It's a complete premium array creation example 1. We made a high, we make a resistance block, we make a low, we make a lower high, and then we made a lower low over here, which makes this a mitigation block, a bearish mitigation block. These two up close candles as our order block. We may also make an imbalance, which is a CB over here. And then this candle over here is our change in state of delivery. So see, everything is all together. That's why I say when we anticipate a reversal, everything is created next to each other. So we can use all of these as our entry pattern if we are confident that the price will go down. We can enter on a resistance block. We make a low, we make a lower high, we make a lower low. We are confident we can enter on an order block entry. We can enter on a fair value gap. We can enter on this bearish mitigation block, or just this CISD area. Okay, these are all entry patterns as explained by ICT, so we can look at charts how they are moving. This is a second example. In this example, I wanted to add a breaker example. If you see here, it was bearish mitigation block, and here it is bearish breaker block. We made a high, we made a low, we made a higher high, we made a lower low, which makes this guy over here as a breaker. We made a SIBI. Many people can argue that we made a low, a high, a lower high, lower high, lower low, and lower low one more time over here. And this would be a bearish mitigation block as well. Totally up to you. This thing is pretty subjective. You can find it everywhere. If you feel like you are confident, you can even make this area over here as a your way of changing state of delivery. But if you want to look at it from a higher perspective, this could be a change in state of delivery as well. So this is our resistance block, this is our order block, this is our bearish breaker block. We have a CB over here, we have a change in state of delivery, and then the price further goes down. Now I added one more thing over here, which is a breakaway gap. This is a topic that we'll discuss later when we will look at the charts and talk about how the price moves. But simply putting, what is a breakaway gap, which is that a gap that is left untouched. As you can see, the price never went into it. It will not go in there unless it reaches its objective, and further in time it will come back, refer to this gap. So that's why it's called a breakaway gap. The price only went into this gap, not this gap. Okay, now we go towards the discount PD arrays. Same idea as the high end resistance block. Here we make a low end resistance block. When we anticipate a reversal, we make a low. We anticipate a reversal, we make a resistance block. The area between the low and the body of that candle is called a resistance block. And after that, we make a bullish order block. So this candle made a change in state of delivery over here, right? So the first down close candle, bearish candles or consecutive candles, these two consecutive candles, before the up close candles that cause the change in state of delivery. These up close candle caused a change in state of delivery. So the first, this black candle or consecutive candles, if they are together, see, I didn't add this candle over here because there was an up close candle over here. So this would be the candle, or these two candles would be order block. BC, we discussed BC. Whenever we have a sudden movement up, we make a BC, which is a buy side imbalance, sell side inefficiency, which means that we had buy side orders, but there were no sell side orders. It's a bullish fair value gap, also known as an imbalance. It's a three candle pattern where the high of the first candle and the low of the third candle makes a gap. Bullish breaker, pretty similar to bearish breaker, in which now in bullish breaker we make a low, a high, a lower low, and a higher high. A low, a high, a lower low, a higher high. The candle of the high would be the bullish breaker. The price always refers to a breaker to make a balanced price range to then displace further. So here we made a low, we made a high, we made a lower low, we made a higher high. So this candle which made the high would be our bullish breaker. Okay, so the bullish mitigation block is pretty similar to bullish breaker block, but in this way we make a low, a high, a higher low, a higher high. But in breaker we made a low, a high, a lower low, and a higher high. The difference is the higher and lower low. Price refers to it and then displaces further. Price refers to it and then displaces further. They are pretty similar. The difference is the low. So we make a low, we make a high, we make a higher low, and make a higher high, which makes this candle as a bullish mitigation block. You see the low over here and the low over here. In the breaker, we had it the lower low, but in mitigation block, we have it as a higher low. That's the difference. Now we'll talk about the change in state of delivery for bullish patterns. We have a downtrend going. We made a high, a low, a lower high, lower low, lower high, lower low, lower high one more time, and lower low. The next is a higher high, which is above this high, and a higher low. We see a lot of displacement and fair value gaps being made in this leg up, and this constitute a change in state of delivery, meaning the delivery was bearish before, now the price delivery is bullish. That's why it's called a change in state of delivery. Let's take a chart example. We were making high, low, lower high, lower low, lower high, lower low, and then we made a higher high, which makes it a change in state of delivery. A higher low, a higher high, the price is bullish now. Complete example for discount arrays. Again, these are called discount arrays because we're going from discount to premium. So we made a low over here, we made a high, we made a higher low. Okay, one more thing I want to add here. If the low did not take the previous low, it would called a higher low. And then we made a higher high over here. Now in all of this, the low to the body of the candle would be our resistance block. The last down close candle before the change in state of delivery candles would be our order block. The candle over here, the high over here with the low high, higher low, higher high would make this as a mitigation block over here. And since our delivery has been changed to upside, we have a change in state of delivery. While we do a change in state of delivery, we make a bullish fair value gap as well. Second example with the breaker. We made a low over here, we made a high, we made a lower low and a higher high. So this low and over here would be our resistance block. The last down close candles, these are two, so that will make our bullish order block. And then we see exactly right after that a fair value gap created, which is a busy, and then our bullish breaker right on top over here. Since we made a high and then we made a higher high, this is a change in state of delivery, so the price will go up. One thing I want you to see here is that how the bodies are not closing below this. Here the algorithm is delivering precisely that it does not want to go lower than this area. The wicks can go, but the bodies remain above that area most of the time. Okay, this was a pretty quick lecture for all the PD arrays, and the reason for this lecture was to help you understand how we look at charts. Like we make a low, how we go up. What do we mean by discount arrays? What do we mean by premium arrays and all that? Of course, it was pretty quick, but to get the grasp of it, you might have seen that all of my examples were from different areas of chart, and they all looked very different, right? So you have to make sure that you have given a lot of time on the charts so that you can easily see all of this happening in real time. Because whenever this is happening in real time, it's really hard to spot. But when you're looking at the charts all the time, like 3 to 4 hours a day, you would be easily able to see that a low was created, a high was created, a lower low was created, and a higher high was created. With displacement, you see a change in state of delivery with a fair value gap get created, a breaker get created, and all that, and that would make your life easier. So putting your time is really important in all of this. And the next lecture would be to take live examples from the chart to see what was happening and how we can find all of these getting created live. Okay, I might make another lecture before that which would be based on time and higher time frames, lower time frames, and all that, and sessions, so that we can go into the charts finally. That brings our lecture to an end. Thank you so much for watching the previous ones and this one, and thank you for your support. We'll meet in the next lecture. Good day and good trading.